Here's what makes this terrifying. That $882 billion? It bought nothing. 0 aircraft carriers, 0 schools, 0 roads. It's pure financial friction. Money paid to bondholders for the privilege of having borrowed money years ago. And it's accelerating. Let me put this in terms that hit your household budget. The average American family pays roughly $3,000 per year in credit card interest. Source: Federal Reserve Consumer Credit Report, September 2024. That feels crushing, right? Now scale that up. The federal government is paying $882 billion in interest, while the median household income is $75,000. Source: U.S. Census Bureau, 2023. That means the government's interest bill equals the entire annual income of 11.7 million American families. Just interest. Just 1 year. Think about your mortgage. Most people spend 30 years paying off their home, and roughly 30 to 40% of what they pay goes to interest rather than principal. You feel that burden every month. Now imagine if your interest payment exceeded your entire household budget for everything else. Food, utilities, insurance, everything. That's where the federal government is right now. In 1988, federal interest payments were $214 billion. Source: Office of Management and Budget Historical Tables. Table 3.1. Adjusted for inflation, that's about $560 billion in today's dollars. We've added $322 billion in real interest costs in just 36 years. But here's the acceleration. In 2020, interest payments were $345 billion. Source: U.S. Treasury Fiscal Service 2020. In 4 years, we added $537 billion, more than the entire previous 32 years combined. The pattern is documented, the trajectory is clear, and history tells us exactly where this leads. Rome faced this exact trap. In 235 AD, the empire's military consumed roughly 75% of the imperial budget. Source: The Roman Empire Economy by Peter Temin, Princeton University Press. By 284 AD, debt service and currency debasement costs had risen so dramatically that military funding collapsed. The borders couldn't be defended. The empire fragmented. The sequence was identical. Borrow for expansion, pay interest on borrowing, interest crowds out defense, system collapses. Spain experienced the same cycle. In 1557, King Philip II declared bankruptcy because debt payments exceeded all revenue from the New World silver mines. Source: Sovereign Defaults Before International Courts and Tribunals by Michael Wabel. Cambridge University Press. The most powerful empire on earth couldn't pay its bills. Why? Interest in previous wars consumed everything. Britain followed the pattern after World War II. By 1947, debt reached 250% of GDP, and interest payments absorbed 40% of government revenue. Source: Bank of England Historical Database, 2020. The pound collapsed. The empire dissolved. The sequence repeats. Now, I know what you're thinking. Big claims require big evidence. So let me verify those numbers and show you why this matters right now. U.S. national debt currently stands at $35.9 trillion. Source: U.S. Treasury, Debt to the Penny Database, November 2024. That's an increase of $15.9 trillion since 2008. In 16 years, we added more debt than the entire accumulated debt from 1776 to 2008. Think about that time frame. 232 years of history versus 16 years of acceleration. The average interest rate on federal debt is currently 3.28%. Source: U.S. Treasury, Average interest rates on U.S. Treasury securities, October 2024. That seems low, right? It's not. Here's why. When rates were 1.5% in 2021, interest payments were manageable. But debt is refinanced constantly. As older low-rate bonds mature, they're replaced with new bonds at higher rates. The Federal Reserve raised rates from near zero to over 5% between 2022 and 2023. Source: Federal Reserve Historical Data. Every $1 trillion of debt refinanced at 3 percentage points higher costs an additional $30 billion per year. Forever. Do the math on your household budget. If you refinanced your mortgage from 3% to 6%, your monthly payment doesn't just increase, it nearly doubles. The principal doesn't change. The obligation doesn't shrink. Only the cost of servicing it explodes. That's happening to federal debt right now, in real time. Here's where it touches your life directly. The government has 3 options when interest payments spiral: cut spending, raise taxes, or print money. All 3 hurt you. Cut spending means fewer services you depend on. Social Security, Medicare, infrastructure, everything competes with interest payments for shrinking resources. Raised taxes means less money in your paycheck, higher costs for everything you buy. Print money means inflation, which is the cruelest tax because it hits hardest those who can least afford it. Between 2020 and 2024, U.S. M2 money supply increased by $6.3 trillion, a 40% expansion. Source: Federal Reserve Economic Data, M2 series. During the same period, median household income rose 8%, while consumer prices increased 20%. Source: Bureau of Labor Statistics, CPI database, October 2024. That 12% gap? That's wealth transfer. Your purchasing power declined while debt service increased. These aren't separate events. They're connected. Let me show you the squeeze in household terms. In 2019, the average American spent 8.6% of their income on debt payments, mortgages, car loans, credit cards, student loans. Source: Federal Reserve Consumer Expenditure Survey, 2019. By 2024, that figure reached 11.3%. Source: Federal Reserve Consumer Credit Report, September 2024. You're paying more of your income just to service past consumption. The government's ratio? Interest as a percentage of revenue hit 15.8% in 2024, up from 8.2% in 2021. Source: Congressional Budget Office Budget Outlook, September 2024. The pattern is parallel. Households and governments are both trapped in the same debt spiral. Student loan debt currently totals $1.77 trillion, with an average interest rate of 5.8%. Source: Federal Reserve Student Loan Data, September 2024. That means students collectively pay $102 billion per year just in interest. Credit card debt stands at $1.13 trillion, with average rates of 21.5%. Source: Federal Reserve Consumer Credit Report, October 2024. That's $243 billion in annual interest. Auto loans, $1.62 trillion at 7.2% average, costing $116 billion yearly. Source: Federal Reserve Auto Loan Data, September 2024. Added up, American households pay $461 billion per year in interest on consumer debt alone. The government pays $882 billion in federal debt. Total interest burden on the American economy, $1.34 trillion per year. That's 4.8% of GDP spent on nothing but servicing past decisions. Source: Bureau of Economic Analysis, GDP data, Q3 2024. History shows us what comes next. When interest consumes revenue, governments face impossible choices. Weimar Germany chose printing. Inflation reached 29,500% per month in November 1923. Source: When Money Dies by Adam Ferguson, 2010. Life savings evaporated. The middle class disappeared. Britain in 1947 chose austerity and devaluation. The pound dropped 30% overnight on September 18, 1949. Source: Bank of England archives. Imports became unaffordable. Standards of living collapsed. Argentina has cycled through both options repeatedly, 9 sovereign defaults since 1816. Source: This time is different. By Reinhardt and Rogoff, Princeton University Press. Each time, ordinary people holding currency lost everything. The United States has one advantage these historical examples lacked. The dollar remains the global reserve currency. About 59% of global foreign exchange reserves are held in dollars. Source: International Monetary Fund, Currency Composition of Official Foreign Exchange Reserves, Q2 2024. That means the world needs dollars for trade, giving the U.S. unusual flexibility. But that advantage is eroding. In 2001, the dollar comprised 73% of reserves. Source: IMF Historical Covert Database. We've lost 14 percentage points in 23 years. China, Russia, and other nations are actively building alternative payment systems. The BRICS nations are discussing a common currency. Source: Reuters BRICS Summit Coverage, October 2024. When reserve status fades, the reckoning arrives. Before we go further, let me show you the proof. These aren't projections or opinions. The Congressional Budget Office projects interest payments will reach $1.4 trillion by 2034, consuming 23% of all federal revenue. Source: CBO Long-Term Budget Outlook, June 2024. That's official government analysis using conservative assumptions. If interest rates rise just 1 percentage point above projections, that figure jumps to $1.7 trillion. The trajectory is locked in unless debt growth stops or rates collapse. Neither seems likely. Compare this to other spending. In 2024, the federal government spent $144 billion on transportation infrastructure, $90 billion on education, $79 billion on veterans benefits. Source: Office of Management and Budget 2024 Budget Summary. Interest payments exceeded all three combined by a factor of 3. Think about what that means. We're spending 10 times more paying bondholders than educating children. We're spending 11 times more on interest than building roads and bridges. The priorities aren't chosen consciously. They're forced by mathematics. Your retirement is directly threatened. Social Security trust funds are projected to be depleted by 2034. Source: Social Security Administration Trustees Report, 2024. When that happens, incoming payroll taxes will cover only 80% of promised benefits. Medicare faces similar shortfalls. Why? Because interest payments crowd out everything else in the budget. There's no money left for solutions. The debt compounds. The interest grows. The squeeze tightens. Here's the mechanism most people miss. When the government borrows, it competes with private borrowers for available capital. That drives up interest rates for everyone. Your mortgage gets more expensive. Business loans cost more. Economic growth slows. In 2024, the federal government borrowed $1.9 trillion, absorbing capital that could have funded productive private investment. Source: U.S. Treasury Monthly Statement, September 2024. That's not stimulus, that's crowding out. Your ability to borrow for a home or business is directly limited by the government's appetite for debt. The pattern is accelerating in ways that mirror every historical collapse. Speed matters. Rome's crisis unfolded over 50 years. Spain took 30. Britain took 20. The time between major sovereign debt crises is compressing. Argentina's 9 defaults occurred with increasing frequency, from 50-year gaps to 10-year gaps to near-constant crises. Source: Sovereign Debt Crises Database. World Bank. The velocity increases because debt compounds exponentially while economic growth is linear. We crossed the Rubicon in 2024. Interest exceeding defense isn't just a milestone. It's a state change. From this point, every policy choice is constrained by debt service. Want to respond to a crisis? Sorry, interest payments come first. Want to invest in the future? Sorry, we're paying for the past. Want to cut taxes? Impossible, we need revenue for interest. Want to maintain current programs? Only by borrowing more, which increases interest further. The trap closes. This isn't a political position. This is mathematical reality. Democrats and Republicans both built this debt. Every administration since 2001 has increased it, regardless of party. Source: Treasury Historical Debt Outstanding. The problem transcends politics because the math transcends politics. Interest compounds regardless of ideology. Debt doesn't care about elections. So what do you do? Understand that inflation is the government's only politically viable escape. They can't default. Dollar reserve status prevents it. They won't slash spending. Enough voters punish austerity. They won't raise taxes sufficiently. Political suicide. That leaves inflation. Print money, devalue debt, transfer wealth from savers to borrowers. It's happened in every comparable historical situation. The only question is timing and severity. Your move. Own assets that hold value through inflation. Real estate, inflation-protected securities, commodities, anything that represents real productive capacity rather than paper promises. Minimize exposure to long-term fixed income promises like traditional bonds. Avoid holding excess cash. The purchasing power will erode because it must erode. It's the only way out of the debt trap that doesn't require political courage that doesn't exist. Here's what keeps me up at night. In 1923, Germans who understood monetary history got out early. They bought foreign currency, real assets, anything tangible. They survived. Those who trusted the system, who believed it couldn't happen, who waited for authorities to fix it, they lost everything. In 2008, people who understood housing bubble dynamics got out early. They sold in 2006, sat in cash, and were bought back in 2010. They prospered. Those who trusted rising prices to continue forever lost homes and savings. The pattern is visible right now. Interest payments exceeding military spending is the warning sign. It's documented. It's verified. It's happening. The question isn't whether mathematics will force a resolution. The question is whether you'll recognize the pattern before or after it resolves. We just crossed a threshold that has appeared before every major sovereign debt crisis in documented history. Rome, Spain, Britain, Argentina. Greece. The sequence is always identical. Borrowing for present consumption. Interest rising. Productive spending crowded out. System breaking. Resolution through currency collapse or default. The pattern is 2,000 years old. The pattern is repeating. The pattern is now. What are you going to do about it? If this pattern concerns you, hit subscribe. I document every historical parallel, verify every claim, and show you the evidence they don't teach in schools. The next video reveals what happened in the 12 months after each historical empire crossed this exact threshold. You need to see what comes next.